Hello and welcome. November is proving to be yet another busy month for markets and for investors. Central banks continue their fight against inflation, their main weapon being to raise interest rates. And that has a follow-on effect in pushing up mortgage and credit card rates, together with the general rising cost of living. And this can be a factor in tilting economies into recession. Indeed, the UK economy did shrink in the third quarter of this year, and the OBR, which is an independent government think tank, has predicted a shallow UK recession for next year. Now, while this implies the downturn may not be as severe as we've seen in the past, there's no doubt that consumers in the UK will continue to face economic pain into the new year. The government's autumn statement on the 17th of November saw tax thresholds frozen, which means that more people will pay more income tax if their wages rise. And on top of higher interest rates and the steep rise in the cost of essentials, people are likely to be cutting back on spending in the months ahead. So the Bank of England raised interest rates to 3% at the start of the month, and they are expected to hike again in the middle of December. So what have markets made of all this? Well, the UK equity and bond markets were actually reassured by the Chancellor's statement and took it in their stride. This was a welcome response following the turmoil around his predecessor's mini-budget in September, which, as we all know, saw heightened currency and bond market volatility. Elsewhere in the US, markets remain fixated on the Federal Reserve, which is their American central bank, with a tug of war going on between those that think policymakers may actually ease rates later next year and those that think rates will stay higher for longer. Global stock markets are having a pretty good month so far in November, and so too actually are bond markets, as they consolidate somewhat after a truly awful year for that asset class. Now, there is some evidence to suggest that global production bottlenecks have eased, and if that continues to be the case, this is one source of near-term optimism. However, we do need to keep a close eye on any new COVID-related lockdowns in China. Bond and equity markets will continue to debate how the future is shaping up, but for now, in our fully managed and SRI portfolios, we remain neutral on equities and cautious on bonds. Thanks for watching. You can find more updates on our Nutmeg Economics page or in the Nutmeg app.